Welcome to The Explainer. Today, we're going to pull back the curtain on how businesses really work. We're going on a journey from a simple idea all the way to a massive company trading on the stock market. Let's break it down. You ever stop and think, what's the real difference between that awesome local coffee shop on the corner and a giant like Tesla? It's not just size and it's not just what they sell. No, the real secret is buried deep in their legal and financial DNA. All right, here's how we're going to tackle this. First, we'll look at the basic choices every founder has to make. Then, we'll get into the real game changer, the corporation. After that, we'll see how companies go public, and we'll wrap it all up with what this actually means for you as an investor. You know, every huge company started as just an idea. But before you can change the world, you have to decide, how are you going to set this thing up? Let's get into the absolute fundamentals. Okay, let's start with a term that probably keeps a lot of new business owners up at night: unlimited liability. This is a huge deal. It means there is zero separation between you and the business. If the company gets into debt, they can come after your stuff, your car, your house, you name it. It's high stakes for sure. So here are the two simplest ways to get off the ground. A sole proprietorship, that's kind of like being a solo artist. You're in total control. A general partnership is more like a band. A couple of people sharing the work and, well, the profits. They're both super easy to start, but they share that same scary risk of unlimited liability. Right, so businesses needed to get bigger, which meant they needed money from investors. But who would risk their entire life savings? So a pretty clever solution came along: the limited partnership. It created two types of partners. You have the general partner, they run the show and still have all that risk, and then you have the limited partners, who are basically just investors. Their risk is capped at whatever cash they put in. Pretty smart. This table really lays out the trade-offs. With these early business types, things are simple. And see that pass-through taxation? That just means the profits pass through the business and get taxed on your personal return. One layer of tax. But the problem is, your personal stuff is on the line, and it's really hard to raise big money. To really scale, businesses needed a totally revolutionary idea. And that brings us to the single invention that completely transformed business as we know it: the corporation. I mean, this structure is the very backbone of our entire modern economy. This is the absolute game changer. The big idea here was to create a business that is legally its own person, totally separate from its owners. Think about it like creating a character in a video game. That character has its own name, its own money, its own problems, completely separate from you, the player. And when you create that legal separation, you get the ultimate superpower for attracting investors: limited liability. Your personal assets are finally safe. The absolute most you can lose as an owner, or what we now call a shareholder, is the money you put in. This is the magic ingredient that lets people fund those huge, risky, world-changing ideas. But of course, there's a catch. There's always a catch, right? This amazing protection comes with a price tag, and it's called double taxation. Just like the source material says, the company itself pays tax on its profits, and then, if they share those profits with you, you have to pay tax on them all over again. Let's make this real. So say a company has a fantastic year, makes 838 million euros in profit. Boom! Before anyone sees a dime, the government steps in and takes its cut through corporate tax. In this case, that's a cool 264 million euros. Gone. So after those corporate taxes, the company's left with 574 million. Now, if they hand that out to their shareholders as dividends, guess what? The tax man shows up again. This time, the shareholders pay personal tax on that money, another 172 million. That's double taxation right there in action. So you might be asking, how do companies that are trying to grow like crazy deal with this? Well, they use a very smart workaround. They reinvest the profits right back into the business. By using that money for new projects or research, they can actually avoid that second layer of tax. It's a huge reason why so many young, fast-growing tech companies don't pay out dividends. All right, so now we get what a corporation is, but they play in two totally different leagues: private versus public. This is where the stock market finally enters the picture. You know, the biggest difference between a public and a private company really boils down to one simple question: can just anybody buy a piece of it? For a public company, the answer is a big yes. Their shares trade on a stock exchange, they're easy to buy and sell, but that means they have to be super transparent about everything. Private companies, they keep their ownership locked down, which makes their shares way harder to trade. Let's take a look at a famous public company, L'Oreal. Now, even though it's public, check this out. A huge chunk of it is owned by the founding family and another big company. That slice of the pie that's actually available for people like you and me to buy on the stock market, that's called the free float. And here, it's not even half the company. So how does the private company actually make that jump into the public spotlight? Well, there are three main ways. You've got the classic IPO, or initial public offering. That's what Tesla did to raise a ton of cash. Then there's a direct listing, which is what Spotify did. No new money raised, they just let existing shares start trading. And then you've got the SPAC, which is a faster, sort of alternative route, where a public shell company buys the private one. Okay, that was a lot, I know. So let's boil this all down to what it actually means for you, whether you're thinking about starting a business or just investing your own hard-earned money. Look, at the end of the day, it's all about trade-offs. It's this constant balance between control, risk, and liquidity. If you're a sole proprietor, you're the boss. You have all the control, but you also have all the risk. If you invest in a private company, your house is safe, but good luck getting your money out when you want it. And with a public company, you can buy and sell in a heartbeat, but you have basically zero say in how the company is run. Which leaves us with a really interesting question to think about. Knowing all these risks and rewards, where's the real opportunity for a new investor today? Is it trying to get in early, finding that next big thing while it's still private? Or is it playing in the big leagues, navigating the huge but super competitive world of public stocks? Honestly, the answer to that really comes down to your own appetite for risk.